Joined by Ross Mayfield, investment strategy analyst at Baird. Ross, great to see you. Thanks very much. Stocks slipping a bit today. No great losses, I know, but what was driving the market, do you think?
Yeah, it's a good question. I think there's mostly just kind of a pause after such a feverish run here. The market's in a bit of waiting mode for CPI. I think there's a little bit of concern that CPI is gonna keep the Fed from cutting on the pace the market wants. But broadly, there's no big concern. No, like you mentioned, just a little bit of drift lower. And all in all, I think still a pretty bullish backdrop here.
And it's a bull market intact and still investable by your lights anyway.
Yeah, I mean, look, valuation is not cheap. We're not, arguing that this is, trough level valuations here, but by length and magnitude, this bull market is still relatively young and weak versus history. So you have earnings set to grow next year. You have the Fed cutting interest rates. You have broadly a policy mix that should be supportive. And just to get to average, you still have room to run. So maybe not 20% plus gains next year, as we saw in 23 and 24, but no reason to get too defensive here either.
And you note that the U.S. economy is driven by the famous U.S. consumer, about 70% of growth. And there are signs of reasonable strength for consumers, high box office receipts, and also massive travel over the Thanksgiving holiday period.
Yeah, I mean, it's anecdotal, but the anecdotal evidence all points to a continued, maybe not strength, but certainly not a weakening in the consumer, right? Black Friday and Cyber Monday numbers were pretty solid. And again, yeah, just little things like traveling, shopping, going out, even the end of the Eras tour here for Taylor Swift, wrapping up. What again was just kind of a showcase for the U.S. consumer driven by the job market. People are still working, so people are still spending, and that's, for better or worse, the American way here.
Yeah, it is interesting that I think there were fears that after COVID put lots of money in some people's bank accounts, they couldn't spend it, or they got government benefits, that would, once that money ran out, and I guess the lower income consumer, yada, yada, was supposed to be hurting, but you're confident broadly on consumer spending.
Yeah, certainly there's a bifurcation here. I think inflation and higher interest rates have hit the lower income consumer harder, so it's certainly not a uniformly perfect picture, but at the higher end of the income spectrum, things still look pretty good. Higher income individuals drive a majority of the spending anyway. And there are still, things like dollar stores and discount stores that are doing well when you look at earnings. So on the whole, in the aggregate, we have a healthy consumer heading into 2025.
And as you note, the S&P Consumer Discretionary Index did get to a record high on Friday.
Yeah, so you've got the anecdotal evidence, you've got the economic data looking at something like initial jobless claims, but it's always nice when the stock market confirms the thesis, right? And you have consumer discretionary, both cap weighted and equal weighted, because the consumer discretionary sector is pretty heavy in a couple of big names, both breaking out to new highs. So the market believes the story as well, which is always nice confirmation to see.
You see a rally in speculative corners in the market where you say that's been taking place. Are you thinking Bitcoin, for example?
Yeah, Bitcoin, small caps, really other coins besides Bitcoin are maybe the more evidence of the speculative nature of the rally. Bitcoin is, somewhat institutionalized at this point, but the other coins, still have that speculative nature. So it feels a little like 2021 in some ways. I think in this higher interest rate environment, I'm still keen to focus on quality and size, but there's no doubt that animal spirits are back to the market. And at some point soon, I think that is the main headwind, right? Is just sentiment is getting really, really spicy here.
What is your outlook for 2025? I think you note that obviously the Trump tariffs will create uncertainty, but inflation during his previous term in office was fairly low.
Yeah, that's one thing we've been reminding folks. Now, obviously, he's threatening more aggressive tariffs this time around, but the first time around, 2017, his first year in office was a great year for the market, 20+%. Inflation across 2017 to 2019 was anchored around 2%, despite all the new tariffs on China and the additional tariff threats on other countries. And then we just know that with President-elect Trump, that tariff threats are a negotiating tool. We expect that new tariffs will be levied, certainly on China, but I would expect that the threats to be more aggressive than the actual tariffs that ended up being levied, and plenty of exceptions being carved out as the first time around. So we'll add volatility to be sure, but it's not something that we're getting too defensive or worried about at this point in time until we really see the policy that gets through.
You cite Charlie Munger's advice, the legendary investor, that you can buy a history book for $30 and you'll get some invaluable lessons worth billions in there. What lessons do you think investors need to draw from history these days?
For me, the one that we've been leaning on heading into 2025, 2024 was all about don't mix investing and politics, right? That would have been a bad outcome for anyone who was scared out of the market or scared into making a bad decision based on the emotion of politics. The market has obviously had a great year. Heading into 2025, the story is just because we've had a good 2023 and 2024 doesn't mean that 2025 is a return to earth year. So we're leaning on that kind of advice. We're leaning on being long-term investors and keeping folks invested, even if valuations are extended and people are nervous about policy upheaval. But we think the backdrop is still pretty strong, and that's the advice we're using heading into 2025.
But you do say that it's rare through history that the Fed has managed to actually pull it off and avoid a recession when they hike rates. Do you think they will manage it this time?
I think they already have. I mean, they're cutting rates at this point. We're multiple years into a hiking and then cutting cycle. There's no economic data that would suggest a recession is going to happen in the next 3 to 6 months. I think they've achieved the soft landing. And to me, the question is just what comes next. So when we look back on the next Fed hike cycle, I think you can count this round in there with 1994, 95 as achieving a soft landing. So kudos to them.
Thank you very much, Ross. Always great hearing from you.
Good to talk to you.
Ross Mayfield, investment